All right, let's dive in. Today we're talking about precious metals. Gold and silver. For thousands of years, they've been the ultimate symbol of wealth. But underneath that shiny surface, there's a huge question that's tearing people apart. Is the price you see on the screen the real deal, a true reflection of supply and demand, or is it all just one big illusion? So, right off the bat, let's tackle the big mystery here. You see the headlines all the time. Mints are sold out of silver coins, countries are buying up physical gold like there's no tomorrow. Basic economics tells you that when demand is that high, prices should be going through the roof. But instead, what do we see? These insane, out-of-the-blue flash crashes that can wipe out billions in value in a matter of minutes. So, what gives? How can both of these things be true at the same time? That's the puzzle we're going to try to solve. And maybe the biggest clue, the thing that just doesn't add up, is this one number, 350 to 1. What on earth does that mean? Well, it means that for every single ounce of real physical silver sitting in a vault that you can actually touch, there are as many as 350 paper claims to that ounce being traded back and forth on computers. Just think about that. It's like a coat check at a party giving out 350 tickets for just one coat. As you can imagine, this creates a massive disconnect, where the price has almost nothing to do with how much real metal exists and everything to do with a digital promise. So here's how we're going to break this down, piece by piece. First, we'll dig into that disconnect between the paper market and the physical world. Then, we'll look at the actual tools of the trade, how manipulation is supposedly done. After that, we'll see what the regulators have to say, explore the big why behind all of this, hear from the skeptics who think it's all nonsense, and finally, look at how the whole system works today. Okay, first up, paper prices versus physical reality. This is where it all starts, in this massive digital marketplace that's a world away from any actual gold or silver mine. Okay, just look at these numbers. They're kind of mind-blowing. The main exchange for this stuff, the COMEX, can see trading volumes of around 750 million ounces of silver in a single day. Now get this. The entire planet's mines only pull about 830 million ounces out of the ground in a whole year. So, in a little over 24 hours, the paper market trades almost a year's worth of global supply. And here's the kicker. The reason the whole system doesn't just collapse, almost nobody ever asks for the metal. Only about 1 to 3% of these contracts actually end with someone taking delivery of physical silver. Everyone else just settles up in cash. This means there's a virtually unlimited supply of paper silver that can be dumped onto the market at any time to smash the price down, no matter how many people are lining up to buy the real thing. All right, so if you've got this massive paper market, how do you actually use it to move the price? Let's get into the nitty-gritty and open up the trader's toolkit. These are some of the main tactics. You've probably heard of spoofing. It's basically like a head fake. A trader puts in a giant order to sell, which they never intend to actually execute. The market sees it, panics, and the price starts to drop. Then, poof, they cancel their fake order and buy for real at the new lower price. It's an illegal but very effective trick. But the really big one is strategic short selling. Now, regulators publish this thing called the Commitment of Traders Report, or COT report. And for years, these reports have shown the same handful of big banks holding massive short positions, which are basically huge bets that the price will go down. So whenever they see the price start to rally, they can just unleash a tidal wave of paper contracts, flooding the market with sell orders. That insane selling pressure crushes the rally, drives the price down, and, surprise, surprise, makes their massive short bets pay off. It's like a self-fulfilling prophecy. And look, if you think this is all just some conspiracy theory, you have to look at the JP Morgan case. This isn't speculation, this is fact. For 8 straight years, their precious metals desk was a criminal enterprise. They ran hundreds of thousands of spoofing trades. It was so bad that the Department of Justice used the RICO Act to prosecute them. I mean, we're talking about the law they used to go after organized crime syndicates. The bank got hit with a fine of almost $1 billion, and top traders, including the head of the whole desk, actually went to prison. This was proof, plain and simple. And what makes all this possible at lightning speed? Modern tech, of course. Specifically, high-frequency trading, or HFT. And it creates this really dangerous situation that traders call ghost liquidity, this illusion of a super stable market that can just vanish into thin air. So, what is this ghost liquidity? Think of it like a fair weather friend. When the market is calm and everything is going smoothly, these HFT algorithms are fantastic. They place thousands of buy and sell orders every second, which makes the market deep and efficient for everybody. But, and this is the critical part, these algorithms are programmed to do one thing above all else: avoid risk. So the second things get crazy, the second there's a whiff of volatility, they are designed to do one thing: disappear. They pull all their orders instantly. That deep pool of buyers and sellers just evaporates in a millisecond. And that vacuum is what causes those terrifying flash crashes, where the price falls off a cliff before any human can even figure out what's happening. Okay, so this has to make you wonder, where are the referees in this game? Where are the regulators who are supposed to be stopping all of this? Well, let's take a look at the watchdogs who, some say, forgot to bark. This, right here, is just incredible. This isn't some blogger. This is Bart Chilton, a former commissioner of the CFTC, the main regulator for these markets. He went public saying that their own rules were making it basically impossible to prosecute the bad guys. He was openly admitting that he saw what was happening and was powerless to stop it. This all came to a head in early 2021 during the whole meme stock craze. You remember the silver squeeze, right? A bunch of retail investors, organized on sites like Reddit, decided to fight back. They tried to force the issue by buying up as much physical silver as they possibly could, hoping to expose just how fragile the paper market really was. And if you're looking for a smoking gun, well, here it is. This is probably one of the most shocking admissions you'll ever hear from a top regulator. The head of the CFTC, Rostin Bainum, later admitted in a meeting that during that squeeze, they tamped down the silver price. Let me repeat that, tamped down. He said they used all available tools to stop it from going over $30. This wasn't them failing to act. This was a direct confession that they intentionally and actively suppressed the price.
And believe it or not, this isn't a new thing. There's this incredible story from back in 2010 about a London metals trader named Andrew Maguire. He blew the whistle to the CFTC, telling them that a massive coordinated price takedown in silver was about to happen. He didn't just warn them, he gave them the exact blueprint for how the banks would do it. And then it happened. 2 days later, the takedown went down exactly as he said it would, and he was emailing the regulators live as it was happening. The response from the CFTC? Crickets. Nothing.
Okay, so let's zoom out. If this is all happening, and the regulators sometimes even step in to help, why? What's the big picture reason? Well, the answer, if you subscribe to this theory, is massive. It's not just about a few traders making a quick buck. It's about protecting the entire global money system as we know it, our fiat currency system. It all comes back to the US dollar being the king of all currencies. And a big reason for that is something called the petrodollar system. Basically, since the 70s, the deal has been that major oil countries will only sell their oil for US dollars. This is huge because it means every country on Earth needs a giant stash of dollars just to buy energy, which creates this permanent global demand for the currency. But being the king comes with this really weird built-in problem. It's called the Triffin dilemma. To keep the world economy running, the US has to pump out a ton of dollars, which usually means running big deficits. But the more dollars you create, the less each one is worth. See the problem? You have to weaken your currency to supply the world, but at the same time, you have to convince the world to have confidence in its value. So, what happens when gold and silver prices start to shoot for the moon? Well, that's like a giant flashing warning sign to the rest of the world that the dollar is in trouble. It's the canary in the coal mine. So the theory goes, if you can keep a lid on gold and silver prices, you can hide the real inflation and keep the confidence game going a little longer.
But to be fair, not everyone is buying this grand theory. There's a whole other way to look at all of this, so let's hear from the skeptics.
And yeah, the other side is pretty blunt about it. A major research firm in the space, the CPM Group, has flat out said this whole suppression idea is pure nonsense. Their view is that the price has never been suppressed and that it's just the natural result of millions of buyers and sellers meeting in the marketplace.
So at the end of the day, you've got two completely different stories here. The suppression thesis says this is a huge, long-term, coordinated effort to protect the dollar. On the other side, you have what you could call the paper cuts thesis. This side admits that, yeah, spoofing and other bad behavior happens, but they see it as isolated incidents, just individual banks or traders trying to score a quick, small profit. They're like minor paper cuts, as one analyst called them. Annoying, sure, but not part of some grand plot to make the whole market bleed out.
So for our last piece of the puzzle, let's look at how the price itself is actually set. The system has changed a lot, but has it really changed?
I mean, for almost 100 years, the price of gold was literally set by 5 guys on a private phone call. Talk about an old boys club. And yes, it was proven that they manipulated it.
So in 2015, they scrapped that and moved to a modern, electronic, super transparent auction system. Much better, right? Well, maybe. Critics point out that while the technology is new, the same big banks that have these massive derivative books are still the dominant players in the auction. They still have a huge incentive to make sure the price lands where they want it to. So the question becomes, did we just put a high-tech digital mask on the same old game? And that's really the question that hangs over all of this. We have concrete proof of manipulation. We have stunning confessions from top regulators. We've moved from smoky backroom phone calls to sophisticated high-speed algorithms. The technology has definitely evolved, but when you look at all the evidence, you have to ask yourself, have the fundamental rules of the game really changed at all? That's the billion-dollar question.